This one tax strategy saved my client $1 million, and 99% of financial advisors never bring it up to their clients. My name's Steven Nelson. I'm a partner at NOM Wealth Advisors. We help business owners grow their wealth, protect their wealth, and preserve their wealth, aka we help them build generational wealth. In this video, I'm gonna break down how we used educational funds for a client to help them save over $1 million in taxes. Now, this is a unique strategy, and I don't hear many advisors talk about it, so I think it's something that you'll probably never heard of before. So we had this client, let's call him Joe, because obviously I can't really name names, but Joe and his wife, Sherry, have 4 kids and have 20 grandkids, and they're worth north of $50 million. This client had an estate tax problem because if you have over $30 million, you end up owing estate tax, and the estate tax is at 40%. So every $1 million over 30 million, you're gonna end up paying 40% tax. So if I had 31 million, for instance, I would owe $400,000 of tax to the IRS because I have more than 30 million. So this client, like I said, they've got about $50 million of assets. For them, that number is going to be quite a bit higher. So for this client right now, before doing anything, they have an $8 million tax problem. So we set out to find unique ways how we could help them lower this $8 million tax down to a lower amount. There were a number of strategies that we used for them, but today I want to talk about the really unique one, because most strategies, when you try and lower this number, is by using trusts where you put it in a trust that you can't really access anymore. But this one scenario that we use, they still have complete control over the asset, but it's out of their estate and they don't owe the taxes on it. So it's really unique because they still have control, but they also get to get it out of their taxable estate. Now, obviously, not everyone watching this video is going to be over $30 million net worth, but the strategy in here is still helpful for anyone because it takes into account the educational funds that are used for kids, which still have great tax benefits. This is just a secondary benefit that this client got, but if you're under 30 million, this whole strategy still makes a lot of sense. It's just not going to save you as much taxes as it does for him, but I think it's still beneficial for everyone. Now, obviously, not everybody watching this is going to be worth over 30 million, so this strategy works really well for people who are over 30 million, but for anyone who's between 1 million and 30 million, there's still parts of this strategy that are going to be super helpful. You just don't get the secondary benefit that they're getting. This still helps for families between 1 and 30 million. If you're trying to help your kids get financial aid, this can still help with that. But for someone like this person, it helped for 2 reasons. It helps for that, and then it also helps for this tax savings. So before we go on further, I want to explain educational funds. So I'm talking about a 529 fund. Some of you might be familiar with 529 funds. Essentially what they are is you put money into this fund for a child or a grandchild, and it allows that money to grow tax-free. So every year that money grows, you don't pay taxes on it. And then when they get to college age, if you use the money for college, and this doesn't have to be a straight 4-year university, it could be a trade school, it could be a 2-year university. There's a lot of things. You can even use it for private school up to $10,000 a year for K through 12. But these funds are growing tax-free. And if you use them for college, it completely is tax-free growth, and they give you a huge benefit for that. You can pull the money out for anything else. We've had clients use it for other things. You just have to pay the taxes on the difference between what you put in and what it turned into. Now, in this client's situation, it was really unique because, like I said, they had 20 grandkids, but of those 20 grandkids, only 16 of them still were either under college age or in college. But we set up an account for all 20 grandkids because of the tax benefit it was going to create for them. But these other 16, we set up regular 529 accounts that they're currently using for those grandkids. So they're getting a double benefit. It's out of their estate, but they're still using this money for college for 3/4 of their grandkids. So they're getting the best of both worlds. And obviously, one of them is the 529, the tax-free growth. So now let's go back and focus on this 40% number, because for them, we put in $1.8 million into these 529s for these different grandkids. So we put in this 1.8 million. They have taken out of this 450,000 and used it for these 16 grandkids. But we've made $900,000 of gains. So right now, rather than having 1.8 minus 4.5, we actually have in this account $2.35 million in these accounts. So like I said, for these 20 grandkids, we put in $1.8 million into the 529s for them. Now, because they have 16 kids that are in college or going to be in college, they've actually used 450,000 of this for college. But what's happened is we've actually actually made $1.1 million of gains in this account. So you got minus 4.5 plus 1.1 million. The value of these right now has actually grown to $2.55 million. So you're probably thinking, how does this 2.55 million actually save them $1 million? That's a great question. And it all has to do with this 40% number over here. Because like I said, if they're over this 30 million, they're going to owe 40% on every dollar above that. So if I take this 2.55 million that's not currently in their estate, remember, I took this out of their estate and it's in these 529s they can use for college, but it's also out of their estate. So if they were to die today, had we not moved this 1.8 out of their estate, this 2.55 million would be a part of this 50 million number. But because we put it into the 529, it's no longer in that. So if I take 2.55 million and I times that by 0.4, which is the taxes, you're going to get the answer of 1.02 million. So just by putting money into a 529, it got the money out of their estate. And we pulled this money out 450 tax-free. So this claim's actually probably low. This is just on the estate tax portion. But by us using a 529 and their grandkids, who they were going to pay for their college anyways, we're able to now save them taxes on income and we're able to save them taxes on estate tax. So it is no less than 1.02 million. So now what I can say is that most people would put this in a trust that they wouldn't have access to anymore, where this is still completely in their control. They still can do whatever they want with this 2.55 million. When it's in a trust, an irrevocable trust, they don't have complete control over it anymore. This money they have complete control over, but yet it's still not in their taxable net worth. I've covered a lot in this video, so I want to wrap up and summarize what we talked about. And where we started was how we saved a client $1 million in taxes. And we did that by opening up a 529 for their 20 grandkids and putting $1.8 million in it. We created 1.1 million of tax-free growth. And if you remember earlier, I said, even if you don't have 30 million, this is still good for you. This is where that lies. Whether they were over 30 or not, this was still 1.1 million of tax-free money. So if you're someone who's 5 million, 10 million, 20 million, there's still tax benefits in this where you can set money aside and you could use this to give money to some school. You could give it to some of your future grandkids, but this created $1.1 million of tax-free growth. It just had the added benefit for them. They get to deduct it from their taxable estate. And the best part of all of this is that most planners out there are going to have you go create an irrevocable trust. With an irrevocable trust, you lose some of the control. So the best part about this strategy is we're using educational funds that you have complete control over. You can pull the money out if you want to. You can use it for whatever you want. It's obviously better if you use it for education, but what most other advisors are going to do is they're going to create a trust and then they're going to make it where you don't have as much control over it. Where this one, my clients have complete control over this. We just choose to use it for college. But for them, it created over $1.02 million of tax savings. And think about if this continues to grow, we almost doubled it in 6 years. Imagine what this number will be in 10 more years. I mean, that'll be a $2 million savings for them. Obviously, I get jazzed up and geek out about this stuff. And if you're someone who this is interesting and you'd like to learn more, go ahead and click the first link in the description, and that's for you. Now, if you liked what you saw here and you're interested in maybe learning more about something else, feel free to comment in the comment section what you'd like me to make the next video on and subscribe. And I look forward to seeing you